Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show. I am Danny Ratliff here with John Penn. Thank you guys for joining. As you can see, the younger, more handsome Lance Roberts is not here today. He's not younger or more handsome. But, and if you can't see us, go to the YouTube channel, The Real Investment Show. We'd love to have you guys. Lance is still out nursing his voice. And Michael Leibowitz will not be joining us either. We have a handful of conspiracy theories. I believe they may be somewhere on a European beach in bikinis together. Speedos, to be, as a matter of fact.
And the Speedos.
Yep. Wow. I'm going to give you guys all kinds of visions. And I've been harassing Brent. I did this to him yesterday. So this is my new goal in life is to,
The imagery in my mind right now is just going off. That's
I know. I regret everything I said.
Rich there?
I'm sorry.
What do you think? Is Rich there somewhere?
He's somewhere, in the background because they can't get enough of Janet Yellen between the two of them. So I'm sure he's in the background with his voice just taunting them.
Just lurking.
Right. Somewhere. Like, what is that noise? Janet, where are you?
Where are you, Janet?
Yeah, of course.
The interest rate announcement was yesterday. What's going on?
So we are going to get to that today. Yesterday I alluded there wasn't a whole lot going on, and today it's actually a fairly big day. We do have initial jobless claims set to be a little bit higher than expected. We will see where this comes in at. Philadelphia Fed Manufacturing Survey, S&P Flash Services PMI. U.S. leading economic indicators. That has been down 23 consecutive months, looking to be the 24th. So this is actually one of the longest times we've seen in history of the leading economic index down. So existing home sales due to come out, and then we will begin to see the parade of Fed chairs. So we have Michael Barr will begin to speak this afternoon. And tomorrow, not a ton, but we do have Fed Chair Powell. Michael Barr speaks again, and then Bostic. I think most people's attention will probably be on the NCAA tournament this weekend. But today, I think people are trying to still grapple with what happened yesterday, which really amounted to not a whole lot. Mm-hmm. We are still in the same kind of conundrum. The Fed said, hey, CPI, PPI, added a little, didn't add to their confidence, but they're still on track to cut 3 times this year. So not a whole lot has changed in that regard. Now, they also said, you and I were talking about this earlier, it's going to be extremely data dependent. And John, what are you looking at, and what are you hearing from most of your clients? Thoughts, concerns, good, bad, and different.
Yeah, I think the outcome of yesterday's conversation with the Fed was in line with what, like, the individuals and families that I've been visiting with. It was in line with their expectations. They didn't expect a change to interest rates yesterday, so we weren't surprised that the Fed left rates as they are. I think a little bit of the takeaway, though, Danny, is, so the Fed is still being very patient, and they made it very clear they still want to give time to let these rates work, right? Like you mentioned, they're going to be very data dependent. Really, they need to have more confidence. They really need to see the data to come in to see that that inflation is working down towards their target. But then there was also now this expectation of, is the market expecting a interest rate cut in June? And so a lot of the folks that I'm visiting with are like, well, okay, we're in March. I mean, how much and how rapidly could the data change over the next 3 months to warrant an interest rate cut perhaps in June or mid this year, right?
Yeah, no, that's a really good point. I think that some of that's going to be is that do we have a lot of this data that's been revised? And we typically do see that, and historically it hasn't been revised for the good. So that may be something that they're looking for and saying, well, what did we not get right initially? And things can change quickly. We've seen it. I mean, there could be something, Lance talks about those exogenous events, and that can certainly occur here. And so we have to be mindful of that. And, we can't just discount and say, hey, things are going to continue to be hunky-dory. And they could be. As of right now, I mean, we know of all the problems out there. We talk about these pros and cons lists that we can create. We look at every different scenario, but it is a challenge when you have so much intervention, there's so much money still flowing out there, Inflation Reduction Act, the CHIPS Act. I mean, there's so many things that are continuously happening and that will likely continue, especially being an election year. And you have to think that if you have an incumbent president, President Biden is likely in Powell's ear, and they're trying to strategize this in some ways, right? I mean, I think this is every president, any businessman. Hey, if you know you're up for election, any politician, you want something good to happen right before? Well, of course.
Sure.
And so if markets are relying on this information and really, the economy, it can benefit it, I think it's likely to happen. Now, we've talked about, do you have this, the Fed's in a really rough spot. They're trying to execute a soft landing, but, we still have very sticky inflation in a lot of ways. Still not down to where their target is. I mean, we're well above it if they're looking at 2%. And they may have to change that mandate over time. I mean, that may be something that happens. And that's not unlikely. I mean, we've heard them talk about how things are so transitory, things are changing quickly, and then it doesn't. But then their strategy has to change. And I expect that to likely be the case here. And so, the Fed, you did mention, that rate cut in June. The Fed has, if we look at the CME Fed forecast or watch tool, they have alluded that, prior to yesterday, it was about a 50% chance. If we look back even a couple months ago, it was way higher at the beginning of this year. Now it's about a 62% chance. So it's actually increased since then. The market had a great day yesterday.
It did.
Market was up. And what I find interesting as well, now we're talking such short term, and there's so many other, factors that we have to take into account here. But, Dow's up 1%, S&P up 0.89, NASDAQ up 1.25, bond yields were down, 4 basis points. That's a pretty darn good day. Bonds were up, stocks were up. It's and for what the market has wanted, though, the market's wanted these much lower rates. And the Fed didn't, I keep hearing this saying, well, there's this dovish undertone. And that may be the case because nothing changed. It wasn't like they came out and said, hey, we're going to be hawkish. Now, they did say that they could keep rates at this stage for longer if necessary. And I think that could be the case. And maybe it isn't June. Maybe it's further down the line. It's July or August, September, somewhere, every 6 weeks these guys are meeting. And so that's one thing to watch. We're looking at, markets today. Dow futures are up. 0.19, S&P 0.32, NASDAQ 0.71. It's interesting just from a short-term basis.
Yeah, I think so too. I mean, you look at the yield on the 10-year, it's about 4.2, hovering there, a little around 4.2. At least the good news with rates being unchanged yesterday, Danny, is, I know you and I, all of us here, we're visiting with a lot of folks who are, yes, they have, money invested in the market for long term. I know we're very active when it comes to managing risk for them in that regard. But, they're still looking at how can they maximize their yield on their emergency funds and their savings. At least right now, you're still getting, pretty attractive rates, down there in the short end of the yield curve, and they're going to stay there because the Fed didn't make any changes yesterday. So at least that's a positive, too, that came out of yesterday.
Yeah.
Right?
Absolutely. And so we're going to talk a little bit about that. There's actually an article in the Wall Street Journal that says the Fed's conundrum, interest rates are both too high and too low. So what do you do with that? And what do you do with this information where not a lot has changed, but we may be getting closer to that stage where it's not so restrictive as Fed Chair Powell will say. So we'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff and John Penn here, filling in for Lance and Mike.
Good morning.
How's your day been so far?
So far, so good.
Yeah?
I got plenty of hot coffee.
Plenty of hot coffee?
Brent has his lava lamp on in here. The mood is right. All is good with the world this morning.
What's your little army men called? What are those again?
These are the lampsters.
There you go, lampsters.
The lampsters.
Yeah, the lampsters.
Yeah. You guys have to check that out. They're pretty cool. Where'd you get that from?
Romania.
Romania.
Oh, very cool.
All right, cool. So, Fed's still dealing with the conundrum, right? And people are now, I feel like you alluded to this, John, getting close to having to make some type of decision, right? We've been able to keep money in short-term, money markets. Now, you've had to go out and search for yield. We know the traditional banks, most of them still aren't paying much. But if you've searched, you've been rewarded for it, and which has been a great thing where you've actually been able to get paid because we've had a decade long of really no interest, more or less. So we're getting closer. You mentioned this in conversations that you've had that looks like the Fed may change. And you just, what data changes between here and there? Who knows? I mean, we know how quickly things can change, but we also know that this can be persistent for some time as well. But if we do get this environment where interest rates begin to drop, what are you seeing people begin to do, or maybe be a little bit more inclined to do than they were previously?
Yeah, so previously, especially for kind of money set off to the side, emergency funds, savings, maybe money that's earmarked for a short-term need. Maybe it's a down payment on a home or buying some property, or maybe if it's, college-related expenses. Now folks are, and they're still keeping some of that money readily available for the near term, but for any sort of emergency funds or savings that maybe they don't plan on using, maybe it's part of that financial vulnerability cushion that you and Rich talk about a lot, right?
Yep.
They've got a good, maybe year or two worth of living expenses set off to the side. Now for money that they don't need here in the near term, readily available, they're willing to go out a little bit further on the yield curve to maybe lock in some yields. Maybe they're not just going out 3 months, 6 months, 9 months, or a year. Now maybe they're willing to go out 2 or 3 years to kind of lock in some yields. Yes, that 2-year bond, that 3-year bond is going to pay you a little bit less than what that 3-month or that 6-month is right now. But if all of a sudden the Fed starts coming in and starts reducing short-term interest rates, now you've locked in a higher rate out there on that 2 or that 3-year mark. So they're just trying to be a little bit more proactive about how they're managing their cash.
Yeah, and I'm seeing people, I think that we have this tale of two economies we talked a little bit about yesterday, in the sense that, there's a lot of different things occurring all at once, and we could see things maybe be more persistent with higher yields for a little bit longer. We do still think that inevitably yields are going to drop. And, if you look at all of the stress that's out there, that's likely going to need to occur. But another strategy that we've seen a lot of people utilize is just ladder those CDs out, where you say, hey, you know what, if we're wrong, in 3 months, we'll be able to renew something, hopefully at the same rate or maybe even a little bit higher. I don't think we're going to see much higher from here. I mean, the Fed's kind of indicated this is likely as restrictive as they're going to get. And so, that gives you the ability, though, to kind of play this game. Now, the problem will be likely is that 3 or 6 or 9 month is going to be less than that 12 month that you did if you just did like a year ladder. And so that's also somewhat counterintuitive to the way that most people think and feel, because right now with the yield curve being as inverted as it's been, on that real short end, it hasn't made as big of a difference. But once you start getting a little bit further out, you begin to see those yields drop. And so where you say, well, shoot, I can go get over 5% right now for 1 year, but if I'm going to go for 2 years, it may be 4.5, or maybe you're still able to get 5, but it's not often. We're starting to see that drop is getting a little bit more substantial. So we've got to watch that. And, while you may say, well, I don't want to go do a 10-year treasury at 4.25, that may look really good in a year or two.
It might.
And you may also have that appreciation with it when yields drop. So there's a couple things that need to be considered where, what are the funds used for? How long until you need them? Are you willing to, if you're going to go out a little bit longer, I had a conversation with somebody yesterday. Well, okay, you're okay to go out a little bit longer, but are you willing to see some volatility associated with this if yields tick higher for a bit? Or what if you're just wrong and, yields go the complete opposite way? Something else happens, like we've seen here in the last several years. It seems like there's always been something that kind of surprises us, COVID being one, the response from a monetary and fiscal policy being another. Those are things that have been very inflationary. What if something else pops up? We talk about the Ukraine-Russian war, all these geopolitical events that can happen quickly. So while most of those are probably going to be more knee-jerk, short-term things, long-term, I think that we're still probably in the same path, but always things we need to be considerate of. And what's your reaction if you start to see some red on something that you believe is a safe asset?
Well, absolutely. And I remember towards the end of last year in October when the yield on the 10-year interest rate on the 10-year bond hit 5%. I mean, for folks that held those longer duration, longer maturity bonds in their portfolio, and we have an allocation to the longer duration side of the yield curve, right? I mean, it was when folks were opening up their statements and looking at their accounts online, they're like, well, wait a minute, why is there so much red here with this particular bond position? I don't understand what's going on. And that goes into the whole relationship between how bond prices and interest rates and the inverse relationship. Bond prices and interest rates, they move like a seesaw, right? And the longer the duration of the bond, the longer that time element, the longer the maturity, the more the price of that bond is going to swing. So, and we really got a sense of that, in October of last year when yields on the 10-year bond really kind of peaked. Well, now we're not at 5% anymore. Now, as of today, I think we're around 4.2-ish, somewhere around in there. So you've seen rates come down. So you've seen some nice recovery in that bond. But to your point, Danny, as you are looking at the fixed income space and looking at where to place your money across the yield curve, you kind of have to kind of get ready and kind of understand what you're putting your money into and how does it react to changes in interest rates or just changes to the market environment in general, right?
Well, that's right. And I think that, another frustration for some people has been that, bonds were so bad back in 22 and 23 that they're just really hesitant because that's always been more of a safe space where, 4 or 5% drop in a bond is a pretty rough year. Where we saw just on intermediate bonds down 18%, down over 30% on a long-term bond. I mean, that is extremely painful, right in line with what the markets were doing. And so, like your traditional 50-50 or 60-40 portfolios didn't give you any reprieve from the downside. Those bonds didn't help, right? So cash was really the only place to hide back then. And so I think that people have had some hesitancy to go a little bit longer. And then even what you mentioned, yields were at 5% back in October. Now, for a brief moment, and I think that most people want to time this just perfect. And I think that's the difficult part of this because it wasn't there for long. We're kind of, and we have a tendency, I think, just human nature. We want to benchmark to that high water mark. Like somebody in their portfolio be like, well, I'm down X amount. Well, you're still up for the year. Well, no, I'm down. Like you get a little bit of a correction, right? well, I was at here. And so this was the very highest this portfolio has ever been. And that's what everybody does. And the same thing when we look at this and say, well, yields are at 4.25 now. I don't want to jump into something like this when it was at 5. But the thing is, we may look back in a year and they may be at 3.25, and 4.25 looked really good.
Yeah.
And very attractive. And so those are kind of the perspective we have to put into it. And also, if you've been burned by a bond, that doesn't mean you can't go back to it. I mean, we see that with stocks a lot where somebody says, oh, heck no, I was in that company before, lost a lot of money, never going to invest there again. And so I think we have to kind of take our own biases out of this as well and understand that there are a lot of options out there. And so while, I actually listened to a podcast and they were talking about, well, people are letting their bonds and CDs mature and they're putting it into the market. I'm thinking, man, we just hit like an all-time high for the 19th time.
Yeah, I'm not seeing that.
Yeah.
That's just me.
I'm
not seeing that.
Yeah. So, and obviously I think our clients are a little bit different
Yeah.
where they do understand the math of loss. They understand that, okay, markets are at highs. Also understand the participation of the market is not as healthy as what we would like.
Mm-hmm.
And so, I think our clients tend to be a little bit different maybe than somebody who's more speculative. And listen, this can go on for a longer period. I mean, there's no doubt about that. We do think that we're due for some bit of a correction. That doesn't mean we're going to go all to cash, and we're a little bit more active money managers than most. But we will, begin to take some profits, and we're going to follow these moving averages as Lance talks about. I know you guys are missing all of his analysis and commentary on, technicals, and I'll leave that to him. We do this, we all do this together, but nobody, let's face it, nobody can articulate as well as Lance can. So we're going to follow those rules and the things that we have set in place regarding that. And, while we do expect a bit of a correction, doesn't mean we're going to pull all the way out and then try to jump back in time that's just right, because that's near impossible.
Yeah, I mean, actually, if the market had a little bit of a pullback here, that would actually be kind of healthy. Maybe work some of this froth out a little bit.
Yeah.
And when Danny's talking about maybe a little correction, maybe it's, and who knows nobody knows what the market's going to do, right? But if it were to pull back a little bit, let's say 3%, 5%, 7%, even as a 10% pullback here, is that in the cards? Maybe, but maybe it would kind of work some of this frothiness out of the market here a little bit. So if there is a little bit of relief, just a little bit of pressure taken out of that valve, then Danny, maybe that gives us the opportunity to nibble a little bit. If it's healthy, right? Where maybe we can nibble and add a little bit to some exposure to the portfolio. So it's kind of, so it's not an all or nothing move, but, we just want to, be active and be nimble and, take advantages of opportunities that as they present themselves, whether that's using some market weakness as an opportunity to get things at a better value, or using market strength to kind of take some fruit off the tree a little bit, maybe prune and kind of raise a little bit of cash, right?
Well, that's right. And so, I mean, when we talk about a correction, we're talking about a 10% drawback, but we may just see where it's 5. We can expect a 5% drawdown each and every year. Historically, we've even seen that 10% where, every year or so you're going to see that drop. So after periods where we've seen maybe a little bit of irrational exuberance where, and I'm not saying we're there. It doesn't feel like we have irrational exuberance. I feel like people feel like, okay, I've been there, done that.
Yeah. Mm-hmm.
I'm okay with this. I've had a couple clients I've visited with recently, and we've talked about some funds that they've just had come due, like they've retired, have funds in cash. And they're like, I'm okay stepping in.
Yeah.
But patience.
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 Mm-hmm.
I'm okay with patience. And I'm okay with missing out too. But we've got to understand that. We've got to, know how to put those two things together. So we're going to talk a little bit more about this when we get back. Child tax credit, we're going to get to today. Seems to be a hot topic right now with tax season right down the road. So we'll be right back after this break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Food in total is now making up 30% of the average discretionary income.
I believe it. I mean, that is our largest expense is food.
Yeah.
And we rarely eat out.
The Real Investment Show podcast.
Our biggest frustration at home is how do we do this cheaper?
Yeah. No, I agree. I agree. We're running Hunger Games at our house.
At realinvestmentadvice.com.
So, if you can make it to the table without getting killed, you get to eat.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I am Danny Ratliff, filling in for Lance Roberts and John Penn for Michael Leibowitz. So I know you missed those guys today. They will be back hopefully next week. If not, we're going to have a little conversation, John.
Well, yes, we will.
That we will. So a lot of conversation about tax season. It is right around the corner, Monday, April 15th. And we've had a lot of questions around the child tax credit. I know there's some new bills to expand this bill. Seems like it's kind of dead on arrival right now. Maybe it doesn't get past the Senate. But what are the things that people need to know right now, John?
Well, I think so. We are getting quite a few questions around the child tax credit, and I used to be really excited about this when our children were were younger than 17 years old, but now they're going to be 22 and 24. So. Oh, to be young again. So anyway, around the child tax credit, it's a federal program. It's a support program for folks, for Americans that are raising children. But there's some criteria there where the children need to be under 17 years old. So our daughters, who will soon be 22 and 24, well, so I'm not going to be part of this group. But basically, it's not a deduction; it's a credit. So basically, right now, if you're a single tax filer, if your modified adjusted gross income is less than $200,000 a year, and you're providing care, providing for at least more than half of the support for a child that is under 17, well, you can qualify for the child tax credit, and it is per child. So it's not, and the amount of the tax credit right now is $2,000, right? So this is not a deduction. So it's not like you're putting money into an IRA and you get to deduct that off your income. It's not like you're putting money into a 401k plan and you get to deduct that off your income. This is a credit. This is after your taxes are already determined. And then if you qualify for this child tax credit, the credit actually goes, it's a credit towards your taxes. So if you end up owing $2,000 on your tax return, but you qualify for the child tax credit, which is $2,000, well, now all of a sudden you don't owe any taxes at all, right? So you can receive up to $2,000 per qualifying child that you are providing care for, but the child has to be under 17, right? And if you are a single taxpayer or a single filer, your adjusted gross income has to be less than $200,000. If you're married filing jointly, it has to be under $400,000. All right. Now, for every $1,000 you're over that mark, if you make $201,000 or $401,000, for every $1,000 that you're over that cap, you can still qualify for the tax credit, but it's reduced by $50 for every $1,000 that you're over that $200,000 or $400,000 mark. Right. Now, what's really interesting about the child tax credit too, Danny, is, well, let's say you get that $2,000 credit. It's a credit against your taxes. If you don't use all of that credit, some of that can be refundable back to you. And that's new, right? That's new. That's the debate. So right now, let's say you don't use all of that $2,000 credit. Well, currently up to $1,600 of that credit is actually refundable back to you. And now the talk is, let's say for 2023, that refundable amount could be increased to $1,800 because up to this point, the child tax credit has not been indexed for inflation. It has not changed, right? So that's part of the discussion that they're talking about now is so maybe you can receive a refund from this credit of $1,600. That's the current amount, but they're trying to increase that, or they're proposing to increase that for 2023 to $1,800. Maybe for 2024, it may go to $1,900, and for 2025, maybe it would be the refundable amount of that might be $2,000. It's yet to be determined, right?
Yeah, and I think that there's a lot of questions around it because people are delaying actually submitting their taxes because they say, well, we've had this bill in the House since January, now it's on the Senate's lap, trying to get something done within the next month, but should I wait? And I think the consistent answer has been, no, go ahead and file, and they'll get you the additional funds if necessary. Well, we'll hold our breath, but something that they say that they're going to do. So I would not delay, I think, is the big thing. I think that's why we're seeing so many questions around it, because people are like, hey, my kids or grandkids need this, or I'm going through this. What should I do? Should I hold off on this for an extra couple $100? I'd go ahead and get it done personally.
Yeah, and the children, the child, quote unquote, or who is eligible, if one, they have to be claimed as a dependent on your tax return first and foremost, right? And you have to be providing more than 50% of their care. But if you are, this isn't just for your immediate son or your immediate daughter. I mean, it could be for a stepchild. It can be for an eligible foster child, a brother, sister, stepbrother, stepsister, half brother, half sister, grandchildren, nieces, nephews. If you are the person providing care to them, then this child tax credit is something that you want to explore. Or and if you have a CPA tax advisor, by all means, talk with them about it as well, right?
That's a great point, because I think a lot of people don't understand, or just nobody's given them the knowledge that, hey, this is not just for small children.
That's right.
And that's what most people think about when we think about child tax credit. They almost need to change the name of this to dependent, maybe.
I think so. Yeah, I think that would be helpful.
It would be. And, we have all this verbiage within the tax code that nobody understands. And I don't think many of them do, because we had to get attorneys to give us what it actually means half the time. But it would be really important for that. And, the child tax credit in general has changed so much over the last 4 years. It went from where it was not a refundable credit to it was only, creditable against any taxable income to you could actually get a refund, to it went up to over $3,000. And if you had children under $3,600, all the way back down to $2,000 again. But it's maintained that refundable element, which has been nice.
Yeah,
for a lot of households.
It really has, and obviously there are some rules around this as far as how the child how you can qualify to receive the child tax credit. Because another one is just residency, that whoever that child, niece, nephew, family member that you are providing more than 50% of their care to, right? Well, they also have to live with you for more than half the year. So I mean, truly, there has to be legitimate support, right?
Yeah, and this is where you see, maybe split family where they're debating over who gets this credit. I want it, and I think that's another thing that most people have to figure out who's going to file, especially if you may have. I mean, we see brothers and sisters where they may help a parent.
Yeah,
and half the year they're with one, half the year they're with another.
Absolutely,
and it's something you certainly need to talk through because you don't want to find out later one of you gets audited and you both claim the same exact person.
Right.
So. Enough with that. Any other, I guess, parting words on child tax credit tax season?
No, I mean, I think we're all waiting to see ultimately what the final decision on this is going to be, but it does seem to be a lot of news out there, a lot of conversations around it. So hopefully that conversation that Danny and I had through there was helpful, maybe brought that to mind, maybe something that you want to explore. But at the end of the day, always good to run that by. If you have a CPA tax advisor, always good to run it by them as well.
Absolutely. Hey, just remember, this is not a specific recommendation for anybody, but do we just want to have you leave any, low-hanging fruit, leave anything out there. So want to get to some other conversations that you've had recently, and so we'll probably spend a little time on this, is that we were talking this morning and just kind of talking through some of the things that you've been seeing or questions that you've been getting a lot. And one of them has been around the insurance aspect of things. And, we are not... we're not your big annuity guys. We've used them. We use them sparingly. I think they can be a fantastic tool for the right person at the right time. But talk a little bit about some of the conversations that you've had. And I think that, I know people are bringing this up to you. So it's something that most people have to be thinking about.
I think so too. So just literally just yesterday, I was visiting with a gentleman, and he's 76 years young. Doesn't look 76 at all, but so he's 76 years young. And he said, John, part of my overall portfolio for my wife and I is that we have an annuity. And and he invested in this, years ago. And to this day, he's 76 years young. And he told me yesterday that he still feels that he has some buyer's remorse from putting some of their money into this annuity. And so we took a step back a little bit, and I said, well, what type of annuity is it? And it was a variable annuity, right? So, he had, put money into the annuity. It was invested in, different variety of mutual funds. That's why they call it variable, because the value of the annuity can vary up and down over time, right? Based upon how those underlying investments are positioned. But now he's turned on the income stream. So now he has the income coming in. I said, okay, well, what are you concerned about? What so causing you concern? He said, well, I'm curious if there was something I should have been doing with my money differently than putting this into my annuity. I said, well, are you getting the income stream from it now? And he said, yes. I said, well, is it enough to cover all of your expenses? Well, between his annuity and their Social Security, kind of their other sources of income, and they don't have everything in their annuity, Danny. They still have assets outside of the annuity. So it's not like everything is in this annuity. But he still has income coming in. And I asked him, I said, well, heaven forbid, if something happens to you, will your wife continue to receive an income stream from this? And he said, yes, we have it structured so that the payment will stay the same. And I said, well, to me, it sounds like you've incorporated this into your overall strategy pretty well, because you don't have all of your assets in this, and this is providing some supplemental income to you and your spouse. But still, to this day, he's 76 years young, and he's still questioning if he should have ever used this in the first place. And that's what I see a lot. Sometimes with folks, when they have annuities, they often question themselves around, well, why did I do this in the first place? Maybe they don't have the real understanding as how the tool is being used within their overall portfolio plan, right?
Yeah, what I find, and we've talked about this a lot, is that annuities or insurance in many instances they're just sold. They're not planned for.
Right.
So when we get on the other side of this break, let's talk a little bit more about that as far as how you should be looking at it. If you are entertaining one, what are the steps you need to take to make sure this is a good fit for you? Because we do find that often. I find a lot of buyer's remorse and a lot of misunderstanding in general. So we'll talk about that when we get back. Hey, if you have any specific questions for us, go to therealinvestmentshow.com, go to the comments. We will try to address them there. You can also go to realinvestmentadvice.com and ask a question there. So we'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to The Real Investment Show. I'm Danny Ratliff here with John Penn. So we get a lot of questions, and we're always happy to take them as well. So go to the YouTube channel, Real Investment Show, and go in the comments. We will try to address those if you have any. But some of the questions that we've received here recently have been around the insurance space. And John was just discussing somebody he visited with who had a little bit of a buyer's remorse. And, we see this often. We see the buyer's remorse or maybe just misunderstanding. And I can't tell you, John, how many people that I visit with who've bought a variable annuity specifically that actually understand it. I would almost say 9 out of 10 don't have a full grasp of how a variable or their variable annuity works. And in this instance with this gentleman, like, you didn't sell this. Like, we don't sell variable annuities. But I do think it's important because a lot of people have them. And, I do think if they're used properly, they can be fantastic. And all these investments used right. And variable annuities have changed quite a bit. I mean, especially if you've had an old one. I mean, I almost feel, I'm not going to say predatorial because I do have clients that have them that I think are really good. The problem is that the very old ones, a lot of them are so expensive. And we've seen the industry evolve quite a bit where more people are using fixed index. There's cheaper options out there. Even the variable annuities have come down in pricing. But, I have done analysis on many that were between 4 and 5%.
Yeah.
You hear from people like, I've never made any money on this. I've had it for 20 years. And you're like, well, it's going to be tough getting out of that 4 1/4 hole every year or 5%. And so depending on what you have and the riders you have on it, the cost goes up. And so I think we need to back up on how would you, if you were entertaining something like this? And I think a lot of the talk is people are looking at these because, one, markets are high. They say, listen, I'd like to participate. So maybe something like a fixed index may work where I can get a portion of the upside and limit my downside. That can be a lot more attractive where you say, I still want to be in somewhat, but I don't want to take that downside. Or maybe they're looking at what we'd call like a MIGA, multi-year guarantee annuity, where they're saying, I want to lock in this rate. We're typically finding a little bit higher rates on something like that than what you can find in a CD. That's something people are looking at because rates are still elevated. Or, you see these people who've had these variable annuities. And so when you have one, and you're questioning it, or if you're entertaining maybe purchasing one, what's the first steps you would take, John?
Well, first, I would see you want to take a look at this big picture. This is how we approach it here, just in general. But this is how I would still approach it too. Is look at this from a very holistic, more from a pure planning standpoint, right? Let's look and see how much income do you need? What do you need to cover not just your basic living expenses, but what income do you need to cover your healthcare related cost? What are your other goals? What do you and your significant other want to do? Is there travel or hobbies? Do you have charitable intentions? Whatever this may be. And what is that amount of income that you need, your portfolio to provide for you? But then we have to look at your other sources of income too. Do you have pensions? What about Social Security? What about, strategic portfolio withdrawals? And is there some sort of a gap that isn't covered by either your portfolio, maybe your Social Security, maybe those other income streams aren't fully covering what you need to, kind of take care of all of those objectives? Then if there's an income shortfall, right, and there's a real chance that you might outlive your assets, that is when maybe we could plug in an annuity where there's some sort of an income stream or a fixed income stream that, no matter what, does not go away. And does that help extend the longevity of that financial plan, meaning that there isn't a risk of you outliving your assets? So I think the annuity, at least in my mind, Danny, it's kind of, it's not like the last resort, but I think it's, if it's really needed to provide an income stream to really help a financial plan survive, I would approach it from that standpoint.
Yeah, and I think this can be a portion of it as well, where you may say, hey, I have Social Security, it's going to give me X.
Right.
Maybe you're really, really lucky and you have a pension.
Yeah.
We don't see that as much, but we do still see that. And you've already taken it. And you say, my expenses are X, my income is this, and I've got a bit of a gap. But I want to fill that, but I'm not taking everything I have. Mm-hmm. Let's just say it's $1,000. What do I need to back into that so that I know that my expenses are going to be met each and every year? And then anything on top of that's icing on the cake. And you still have your variable assets, which is going to be to combat inflation, to get you better returns over time. I think that's a way that you can look at it. So that's why we talk about that these should be planned and not sold.
Yeah. And
so many times we hear, and listen, I've been in the car and hear radio shows that are strictly designed around annuities. And, I've heard these guys in multiple times, oh, everything you've got, you can put into this. This is great. How much, the big question, how much should I put in something like this? And, no, absolutely not. Number one, they're very illiquid. Number two, if you need to get to additional funds, historically you can do 10% a year out of most of these products. Not all of them, but a lot of them. But if you needed more and you put everything into it, there's a pretty hefty penalty associated with it. And that's where you typically see somebody with buyer's remorse, where they've done something like that. And those are typically times that you were sold them. And, we get a lot of questions around, like I've had people, I've even had my dad, like, how come you guys don't do those steak dinners? And I'm like, well, that's not exactly how we're designed, Dad. And, but, where the thing is that there's probably a 10-year difference, give or take, between all of us in this room right now.
Yeah.
And we could all walk into one of these rooms, and for many of these people, listen, there's a lot of really good annuity guys out there, some very, very good ones. But there's also a lot that, if all you have is a hammer, everything's a nail. And so we could be at different stages of life, and they would yet say, you need this. Oh, you need the same thing, John.
Yeah, we're all going to get the same thing.
I need
right?
the same thing. And that's not always the case. If, everybody's doing something or maybe needs something a little bit different. And so we have to be cautious with that. And that's where I think you see that more of that buyer's remorse in a lot of these people who say, oh, yeah, don't worry, just put it all in. But my question is always, well, how did you get to that number? Right?
Yeah.
If you haven't done a plan and if you haven't laid it all out and looked at all of everything you have and actually broken it down and looked at it long term from a longevity perspective, and not just for you, but if you're married, for you and your spouse, I think this is extremely important and sometimes often overlooked if there's just one person at a meeting or maybe you just feel like you're the one that takes care of this. You need to start thinking about the big picture long term. And without that plan, I find that to be difficult, and to know exactly how much you need to put into something like this.
Well, I agree, and it's kind of the same. I get a lot of questions around long-term care insurance too. Hey, John, is a long-term care policy something that I need? Because maybe they've just visited with their insurance professional,
Yeah.
Right. And their insurance person says, hey, Danny, you know what? You and Michelle need this. You need a policy that's going to,
Oh, that's a great point.
Provide $300,000 to $400,000 worth of benefits if either of you have a long-term care need. It's like, okay, well, wait a minute. Where did you come up with that number from? Right? It's like, so that's my question. When somebody will call me and say, hey, this is what is being recommended to me, my next question is going to be, well, did they look at all your stuff?
Well, yeah, that's right. Because you find so many times that it's clearly looked at nothing. But they said, oh, look, Healthview Services said that, you're going to need $350,000 in retirement on healthcare expenditures. And if you go into a nursing home, it's going to cost you X. And so they come out with this number and say, well, I'm making up a number here, you need $7,000 every month. And so what they do is they'll go put out a policy that says, here, look, we're going to pay you $7,000 a month, but it's going to cost you an arm and a leg, and you may not be able to get there because you're going to spend so much on it in between it. So what John's alluding to is that you need to break that down. And here's what we see is that if that's not done, you say, okay, just like we mentioned earlier, what are your income? What are your assets producing? What's your Social Security? What are all these other elements that come in to provide you the income you need to live? And then is there a gap? Or is this a way to mitigate and leave a legacy? I mean, sometimes this is a legacy intent conversation as well. And we have some very wealthy clients that'll go out and purchase long-term care.
Absolutely.
Because they're like, you know what? I can put these funds aside. This helps mitigate some of that risk. I feel like I'll have more left over by investing the other funds somewhere else and letting those grow. I mean, there's a lot of ways that you can take a look at this and use it to your advantage. It's not for everybody. I mean, we visit with a lot of people who come to you with that question. And I bet you've told a lot of people that, you know what, you're self-insured. Don't worry about it.
Yeah, and in no way here am I saying that long-term care policies are bad. I mean, they can work very well for the right person in the right situation, right? But you have to, just like Danny was alluding to, you kind of have to back into the number a little bit, because you have to look at all these things like, well, let's look at your investable assets. Let's look at your other sources of income. Hey, you know what? You may have properties, you may have land, you may have real estate. If you or your significant other needs a long-term care event or needs some assisted living help or some medical, there's some larger medical expenses or medical care that's needed, are you going to keep all that land? Or are you going to keep all that property? Or will the one spouse, maybe some of that can be sold to provide some additional liquidity to come in and take care of those medical expenses, right? So, but there are times where maybe there's a gap. Maybe somebody doesn't need $350,000 worth of a long-term care insurance policy, but maybe there is some that's still warranted, but it's just to fill up a smaller piece, right? So you just have to look at it from more of a holistic standpoint, right?
Yeah, and I think that there's so many moving parts with these, not only needing to understand, how do you back into the numbers, but also understanding the different types that are out there.
Right.
I mean, we talked about two different types of annuities. There's many, right? Lots of different ways for you to utilize these tools and utilize them for something different. They may be good for you're looking to create a death benefit, or you're looking to create a guaranteed income stream. Maybe you just want to participate in markets, but you want some downside, or you want to lock in a yield. That could be, you could do that, but with all different types of annuities. Long-term care, it's not just that traditional old school long-term care. There's hybrid policies. There's all kinds of different things that are out there. So talk with a professional if you need some help. Thanks for joining us today. Go to the Real Investment Show, hit the like button, subscribe. We appreciate you all being here. Tomorrow, you guys will have Richard. Y'all will have had enough of me. Have a great day. Thank you.